Hi,
Uh,
Kim.
Good morning. Is Kelly full screen now?
She will be in the recording.
Okay, because it should be recording right now. We're good?
Mhm.
All right.
So I should go
fantastic.
ahead and share then, Kim. Should I share at this point?
Let me give you sharing capabilities.
Okay. While you guys are doing that, good morning, everybody. Thank you for joining us. We do this every single Tuesday morning, same time on this same Zoom link that you're on. If you guys know agents anywhere that you're friends with or agents you care about, we do masterminds again every Tuesday and have rock star agents coming on here like Kelly that you're going to hear from this morning. A lot of these folks been in the industry 10 plus years. A lot of them do tremendous volume. Some are 8, 10, 15, 20 million and greater. So we're very fortunate to have this, the number of icon agents on our team. We call them icon agents, people that reach a certain level of production that come to us every Tuesday and give us just incredible content, incredible masterminds. So we're going to go through some of that here this morning with Kelly. Let me give you a little background on this lady. She has a very, very diverse background, phenomenal lady. But Kelly has been in the industry now for 20 years. She has over 90 doors. In other words, she's done a ton of investment property. She's going to talk a lot about some of that as well. That's all in the last 10 years, 90 doors. She's been a realtor with EXP, but also a financial advisor. We've got a couple other agents on the team now that are working with her directly as an advisor. She conducts wealth summits quarterly to bring great value to the realtor community. And today she is going to share how to create wealth momentum with your investments. So if you're like me and Kelly, I'm all ears this morning and always going, what could I do with my money other than just sitting in a bank account or maybe put in some kind of traditional investment? She's going to give you several different ideas and things you can do with your money to help it grow faster. So Kelly, I'm definitely fired up about this. I hope some of you are. So let's turn this over to the wonderful Kelly Fasterling. Thank you so much, dear.
Thank you, Sean. Let me go ahead and share my screen then. And we'll slide over here. So I think we're good now.
Looks good.
Okay, perfect. Can everyone see that then? Where it says building wealth momentum? Sean, can you see that okay?
Yes.
Okay.
Good.
Okay, perfect. So this is a topic that's very, very close to my heart. And let me kind of share why it is. And let's see, there we go. Let me just tell you a little bit about my background. So I was in the software industry for about 25 years. Coming out of school, you get a good education, get a good job. All you know about when you're corporate America is your 401k. In Fidelity, I had 6 accounts. I could pick them, but that was basically all you get. And so then you are making these choices. And as life progresses, 2001, I lost half of that. 2008, I lost half of that again. And then 2006, I got divorced, and then I got to share a portion of it. So I went through this decade from 2000 to 2010, and a lot of people probably had a similar experience, maybe minus the divorce, but where they just lost a whole lot of money. And so going through that period of time, then as I got divorced, I took on sole financial responsibility for my 3 boys, who were at that point 11, 13, and 15. And in that same year, in 2006, I lost my corporate job. So here I am, just trying to figure out life as a whole, what direction to take, where to go. And Kim, are you letting people in, or should I continue to admit them? Okay, it looks like you're getting them. Okay, so anyway, I came out of this corporate environment thinking I've got a whole lot of fixing I've got to do on my financial situation. So I started down the path of let's get educated about real estate investing, because that, to me, after reading Robert Kiyosaki, Rich Dad, Poor Dad, I don't know if any of you have had that chance, but great book. Gives you an opportunity to kind of reevaluate kind of business as a whole and investments as a whole. So I went through his entire mentoring series and started buying properties myself. Then I got to the point I couldn't find the next one. It was kind of like this market where you put in an offer and you get 20 offers right behind you. Well, this market 6 months ago, and it was very difficult to land something. So I started then reaching out and found a group that actually invest in other markets outside of Colorado where our prices were too high, and they do it all for me. So I started down that path doing that with them, and that worked well. And so in the process, then I started referring people to how I was investing and got my real estate license to get those referral fees. And then I took the next journey, which was learning how to kind of become my own bank. What that means is as realtors, we tend to sit very cash heavy in our accounts. If we're commission based, we sit cash heavy. We don't know when the next deal is going to come. So we have a very high percentage potentially of money just sitting in the bank, kind of hoping that next deal comes, compared to somebody who has a very steady paycheck. They don't sit as near as cash heavy. Well, as a real estate investor, you also sit cash heavy because you're getting cash flow off your properties, but you're also saving up for that next buy. So I learned then how to create a different kind of investment strategy that actually pays me while that cash sits there, but then it's liquid for me when I'm ready to go buy something. So that was a unique opportunity. And as I was bringing all my real estate friends to this group to say, they also want to do the same thing I'm doing with being their own bank, I wanted to get paid on that. I had to get an insurance license. So I did. And then followed on with the securities license. So with all that said, bottom line, I'm sitting here as a realtor and a financial planner, and anything and everything I share with you today, it's not personal advice, but it's to give you kind of some ideas and some concepts of different things that you can do. And then we can sit down together and kind of walk through the personal advice part if that's a step that you want to take. Okay. So let's start with, we have all the things we do now to make money. And then long-term, when we shift into whatever retirement may look like, it might just be we have more passive and we can pay our bills with our passive, but it might truly be, I don't want to sell any more houses. There's both. So as a realtor now, we just continue to sell more homes or sell pricier homes, or potentially we engage in that EXP modern team concept, or actually have a traditional team. But long-term, we look at kind of our retirement sources. We'll all get Social Security. And then maybe some of us are lucky enough to have a military or a pension from a company prior to us being realtors. Or we create some other passive income sources like rental real estate, or potentially overrides from team. Otherwise, we've saved our money, and therefore now that money can help us in those later years to augment what our retirement looks like, because Social Security, frankly, just doesn't cover enough. Okay. So today what we're going to focus on is just that last line, that personal savings and investments, and what options and how might we evaluate what's best there. Okay. So when we are evaluating an asset and we're trying to determine where do I put my money, how much should I invest, and how, these are the 5 main categories of things that we look at. The liquidity, how safe is it, how expensive is it to put it in a certain spot, how much will it give me back, and then how tax efficient is it. Okay, so if we had all of those things where an asset was 100% liquid, that would be nice, because as a real estate investor, if I tuck my money away, let's just say in a traditional IRA or a SEP IRA, it's not liquid. I can't touch it. Well, I could touch it now. I'm over 59 and a half, but Sterling couldn't touch it until he's 59 and a half if he put it away in a traditional IRA. So liquidity becomes a concept and an evaluation criteria. Safety, though, it's got to be on all of our minds right now with the stock market taking its hits. And you reach back to 2008, 2001, when we took those hits. Nobody wants to go through all of that again. If an asset had absolutely no expenses, it would be ideal. Now, if you have your money with an account manager, a money manager, an Edward Jones, a Fidelity, there is an expense there, might be modest, but you got to count that in. And then returns, everyone wants just an awesome return. And then tax efficiency, really, there are 4 times an asset can be taxable. One is when you're contributing to something. Okay, that's why a lot of times our tax accountant will say contribute to a traditional IRA, so it's deducted from your taxes now because you're in high earning years. But then the other 3 times are when the assets grow, when you take money from them, and then when you pass away and it goes to your heirs. So there are 4 times that an asset is taxable. A traditional IRA, it gets tax deferred the first time, but not the other 3. With a Roth IRA, it's the other way around. You pay tax on it while it goes in, but then the growth, the transfer, and the distribution are not taxable. So you're always weighing the taxability of assets. Okay, so let's delve into each of these just a little bit. On the safety, we all remember this. You know, this was me in 2001, losing half my base. This was me in 2008, losing half my base. Now we had this little blip for COVID, and now we're having another blip right now where the market's lost about 25%. But, you know, that's keeping up with the safety of the assets. You know, when the market drops, how much are we willing to have at risk? Now, another aspect of safety that most people don't consider or really haven't been exposed to is interest rate risks. So in our investment history, you know, I've been investing since roughly the 1980s. Some of you are with me, not too many, but since the 1980s, the interest rates have dropped. And I don't know if anyone remembers buying a car or a house back here when interest rates were just at an all-time high. And they've come down to truly all-time lows more recently. Well, now they're starting to pop up. So in our investment world, the traditional advice has been, you know, when you get a little bit more uncomfortable, you slide across to bonds. Well, with interest rate risk, that makes bonds a little less safe, because in this environment from the 50s to the 80s, when interest rates were going up, what happens is it creates this interest rate risk for bonds. If you sell a bond before maturity, you may have to take a discount on it. So there's flip-flopping between stocks and bonds now probably in our next 30 years might carry some interest rate risk that we have to be aware of. And then if you remember Albert Einstein and his comment that compound interest is the 8th wonder in the world, and he who understands it earns it, and he who doesn't pays it, which is just a real interesting concept. Now let's put some numbers to compounding. So for those of us that may sit cash heavy in the bank and we're earning kind of less than 1%, the rule of 72 is just a real simple way of looking at how, if you put your money in an asset and it earns a particular percentage, how often will that asset double? So for instance, if you put an asset in an 8% earning asset, it will double about every 9 years. So 8 times 9 is 72. If you put it in a 12% earning asset, it will double every 6 years. And in a 6% earning asset, every 12 years. So if the asset earns less than 1%, like 0.1%, it's, you know, you aren't going to see it double in your lifetime. So you get a good feel that in 36 years, what that doubling would do to that same $10,000. So sitting asset heavy in the bank doesn't serve us in terms of growth. Okay, but now we got to balance out the safety factor. Now, this is the concept, and again, I'm just sharing with you just different ideas and different concepts. This is the concept of the power of zero. If you had $1,000 and you had invested it in, let's just say the market back in the 2000 to 2010, and you put it in and it went up 10%. And then let's say the next time it drops 10%. And then in the third year, it goes up 10%. And the fourth year, it comes down 10%. You think, well, it's up and down 10%. If I put in $1,000, I'd end up with $1,000. Well, that's not the case, because each time it drops 10%, it's got to claw back more than 10% just to catch up. For instance, if you had $10,000 that you had invested back in 2008, and if that 10,000 lost 50%, that account dropped to 5,000. Now, how much do you have to earn on that 5,000 to get back to 10,000? Well, you've got to double it. Okay, so even though you lost half, you have to earn 100% to get back. That's this concept of this, lose and gain, where your money actually drops when you're losing the same amount that you're gaining. But let's invest in an asset that kind of employs the power of zero, which is the market goes up 10% and then the market drops, which means we get nothing. Okay, because the market's dropping, you aren't getting any interest. And so you get zero, so it stays level and flat. But then the market goes up again and we start back at that same point and go up. And then again, we get zero in the next year. So same market, but a wholly different result, where that same 1,000 then increases to 1,600 versus 950 if you employ that power of zero, which means we aren't taking those losses. So back to the elements of a perfect asset. We have liquidity, safety, low expenses, return, and tax efficiency. This just kind of fleshes it out a little bit, where when we put money in an asset, ideally, if it's 100% liquid, meaning we can pull it back out and maybe we had a bad real estate month, it's December, we didn't have a sale, we need a little liquidity. Or if you're like me, well, maybe I want to go buy another house, then I want some liquidity. That's what that liquidity means, or I can leverage it. We'll talk a little bit more about that. For safety, we're all familiar with that market risk, but there are other things that enter into the safety category. Creditor risk, I get sued. Default risk, a company goes under. Interest rate risk, we talked about a little bit, and then the power of zero. All of those come into that safe component. Expenses kind of speak for themselves. Would like to have assets with no expenses, great rates of return. And then we talked a little bit about this tax efficiency. These first four kind of target the traditional IRA versus the Roth. Do you have one or three? But then as we, especially as really solid producing realtors, and we try to go then contribute to Roth, there becomes some income limits. If we're making too much money, we can't even contribute to a Roth. And then we have to take it out at a certain age. Once we hit 72, we have to start taking it out. So then there become all these rules around how we manage our own money. Okay. So let's look at kind of different assets and kind of the big picture of investments. And you're probably familiar with most or all of these, from the stock market and mutual funds to annuities. Are, instead of investing in companies, you're investing in life insurance companies. So a variable annuity is really like a mutual fund inside a life insurance company. Okay. And then bonds are debt instruments off of a company. Okay. Now cash, that's like what we have in the bank. A CD is a contract with a bank where we'll let them hold, let's say $10,000, and they'll pay us an interest rate. Let's call it 2% for a period of 3 or 5 years. So it's a contract where they guarantee a return over a period of time. Now, a fixed annuity is really the same concept as a CD, but instead of the contract with the bank, it's a contract with a life insurance company. So instead of getting maybe 2%, maybe you get 3%, but then maybe they hold it a little longer. Same idea. A fixed indexed annuity is also a contract with a life insurance company, but it's indexed against the market. So now it's kind of combining some of the benefits that you might have with stocks, but without some of the risk points. So if we look at the risk points, we always think of bonds being a little less risky than stocks, which might have more risk to them. But all of these on the right side have that principal protection, that power of zero, where we are not losing money. Okay. But on the reward side of it, we see that, we would expect stocks and mutual funds to have a little more growth potential, but likewise going up the scale, we would see that the indexed annuity would have the most potential on the growth side as well. So that's just kind of a basic different asset classes that are available for investments. It's really banks, companies, and life insurance companies. Okay. So now I'm going to kind of pull it all together. Let's go back to the elements of a perfect asset. And as you well know, there is no asset that has all of those things exactly the way we want them. But there is an asset that is really quite interesting as a piece of your portfolio. And that's like taking that indexed annuity and adding a life component to it, a life insurance component to it, which makes it a little bit interesting. Let's talk about why that one is interesting, especially for folks that sit cash heavy or folks that invest a lot. What's interesting about it is it carries full liquidity and leverageability. So for instance, this is an asset I have in my portfolio. I put money into it. When I have enough from cash flow from my houses or from savings from my real estate or financial planning, then I can easily loan that money to myself and go buy my next house. Now, what does that mean? That means it's still earning while it's in that product. And at the same time, it's earning in my house. So now I'm double dipping on the same dollars. So kind of an interesting concept there. It has all the safety factors that you would want in any asset. Now, it's life insurance. So you're probably sitting there saying, well, there's no way it has no expenses. Over time, those expenses are paid back to you. What that means is I've done illustrations for like a 27-year-old, and within about 3 years, all their expenses, their cost of insurance is paid back to them basically in dividends from the life insurance company, because we select companies that are owned by the policyholders. Okay, so if you're more my age, then it might take 10, 15 years for a payback. But you can get into products where eventually the expenses are fully covered. Rates of return are good and solid and very comparable to market-based assets. And it operates like a Roth, where the premiums you put in, you'd pay tax on it, but the growth, the distribution, and the transfer to your heirs is all tax-free, and it doesn't carry any of those IRS limitations that we're used to when we're dealing with traditional or Roth IRAs. Okay, so let's kind of compare some of these assets and say, well, let's take a couple of the things we know and look at how they stack up. With our bank assets, they're 100% liquid. That's why we sit cash heavy, because we need the liquidity in case we have a bad month. They're 100% safe, protected by the FDIC insurance. Typically, we don't have expenses on those accounts, but they tend not to earn anything for us. The tax efficiency, they're taxed on the gain. So they're okay. But we're sitting here thinking, we go back to Albert Einstein's compounding eighth wonder of the world, and we say there's utterly no compounding on that account. So any cash that we sit in the bank, it's really not helping us in the long term. In fact, it's going backwards with inflation. So if instead we want to stay in a more liquid environment with stocks and bonds, we can put it in. If it's a brokerage account, we can put it in, take it out. If it's an IRA, a traditional IRA, there are some rules around when we can take it out and whether we have a penalty. So depending on the vehicle that we're investing in, it can be 100% liquid. But as we well know, based on our history, actually the market, it's not just 2001 and 2008. It's about every 7 years we see a market correction. Now, this last period from 2008 to now has been the longest bull market in the history of the stock market. And so the fact that it might be doing a bit of a correction now is frankly overdue. So they are not safe in environments. Now you can tightly or tactically manage them so that maybe you're shifting back and forth, but that timing is imperfect, even for folks in the business that manage it. It's imperfect. And there's typically an assets under management fee associated with stocks and bonds, usually in the 1% to 2% range. The rates of return can be very, very solid. And then you can kind of select your tax efficiency, whether it's in a brokerage account and it's taxed and liquid, or whether it's deferred in a traditional account or in a Roth account and has all the tax efficiencies that are available today. Now let's stack that up with indexed universal life. Well, actually, I'm going to go back to where it's not safe. In your mind, you're looking at that power of zero and saying, we get all the upsides, but we also take all the downsides too. And so that is our risk with stocks and bonds. Now, indexed universal life, it is 100% liquid. Put it in, take it out when I want. It's 100% safe. So it's got that power of zero component where it doesn't go down. The expenses can get covered if it's structured and funded right. Rates of return are very comparable to what the stock market does, and it's taxed like a Roth. So for a high income earner, somebody who's an icon agent, and they can't really push much into a Roth investment, this gives them that capability to push into a Roth-like structure with all those tax efficiencies and yet get all of the other advantages too. So we find that a lot of real high income earners tend to shift into this concept as a good foundation product for their portfolio. So now let's shift into how do we take that baseline, all of that information, and start creating momentum on that wealth. Okay, let's go into a little bit leverage. Now, we all are very familiar with leverage in the real estate world because most of our clients and most of us that have invested before, we leverage the mortgage company or the bank to pay for maybe 80% of every house that we buy, and we put up 20%, or they might even pay for more of that. So we're very familiar with that power of leverage. And then on that equity, we get 100% of the gain. So if we buy a house for say 500,000 and within 3 years it goes up to 600,000, whether we had a mortgage of 400,000 on it or whether we had paid cash for it, we still get that same gain, that same 100,000, and that's all ours. So that's kind of the concept of leverage. But now let's kind of take it a little bit further. Let's say that you owned an apple orchard out here in Colorado on the Western Slope. And that apple orchard, you had a contract with Walmart, and Walmart would pay you $11 a box. Now, at some point, you're going to run out of apples to sell. And so you're confined to the size of your apple orchard. But let's say you've got a neighbor that has an apple orchard and they really they have excess and they want to sell you some of their boxes, and they're willing to sell their boxes to you for $5 a box that you can turn around and sell to Walmart for $11 a box. So if you could get that kind of leverage, now you're expanding out and you're going to other neighbors and other orchards. How many of those neighbors are you going to go talk to? Pay them $5 a box, which for them was a good deal because they could only get less than that, and then turn around and sell it to Walmart for $11 a box. You'd probably do that all day long. Now let's switch it to the concept of money. Okay, if you had $1 and you could invest that dollar at 11%, at some point you run out of dollars to invest because you're earning so much and you just that power of your investment portfolio, but you would do that and earn the 11%. But if you could use somebody else's money and pay them 5% for the use of that money, but then turn around and earn 11% on it, that's what we call a positive arbitrage. Okay, you're getting a positive arbitrage of 6% on that somebody else's money to earn it in your account. So basically, how many of those dollars would you deploy? You'd deploy your own and earn 11%, but then you could deploy the bank's money and earn another 6% positive arbitrage, the difference between the 11 and the 5. So that's the power of leverage in that financial world. Okay, so let's talk about that concept of leverage and combine a couple of these concepts. Okay, and we call this really the power of and instead of the power of or. Okay, we all think of investment as I could choose stocks and bonds, I could choose the bank, I could choose an annuity, I could choose a CD. Here are all my choices. Where should I put my money? So if I chose the stock market and we looked at the history of the market from 1990 to now, and you took a $100,000 investment, as of 2013, that investment would have grown to about $500,000. You might have been just fine with that. Now, instead, you could have put it in, say, an indexed universal life product. You could have had that power of zero and not taken some of those hits and those losses and earned just a touch more over time. That asset would have grown to about 800,000. So if you chose between, should I have it in the S&P or should I have it in indexed universal life, and you knew all of this in advance, you probably would have picked indexed universal life as just a place to park the money. Okay. Now, what if somebody came to you and they said, instead, I've got this asset that's secured and it will get 12%. For instance, with my real estate, 12% is even a little bit low with real estate done well and done right. But let's just use the 12% number and say if you were pretty certain that you would get a nice steady 12% without the safety risks, then, and you compared to the other two assets, the indexed universal life and the stock market, you probably would have picked the 12% asset, which is where I was headed with my real estate. When I got done with the Robert Kiyosaki training and I looked at investment in real estate, it was like, that's powerful. That's better than sitting over there in Fidelity and taking these hits that I was taking. So that's when I shifted to real estate. But then I started to learn about the power of leverage. And now we kind of add that on. So if I take my money that I'm saving for my real estate and I tuck it away in an indexed universal life vehicle, and then I borrow it out. So let's say it's earning 9% in this vehicle, and I loan it to myself when I get enough money to buy a house. And so I go buy the house. So now my money is truly not in the life insurance vehicle anymore. It's physically in the house because I made a down payment on a house, but they still count it in the life insurance vehicle. So I'm still earning 9% on that money, but I'm paying them because I'm leveraging. I'm paying them 5% for the benefit of deploying the money over here in my real estate. So my positive arbitrage is 4%. So I couple that, what it's earning minus the leverage, plus what it's earning over there in real estate. And if we just mathematically run those numbers, the returns are significantly higher if I deploy both concepts. So this is called really the power of and it's the ability to deploy this indexed universal life product in conjunction with just really truly any other asset. Now, my asset of choice is real estate, investing in real estate. Yours might be cryptocurrency or the stock market or futures investing or something else. But the same concept applies if you can invest it in something else and it will earn more than what the leverage is. You know, in our previous examples, if it earns 11% and your leverage is 5%, if it can consistently earn more, then you might be willing to leverage that asset and have it earn that same dollar earned twice for you. So now let's go back, and as we compare this, not only do we have an asset that gives us the liquidity we need in a commission-based world, gives us the liquidity we need to invest, gives us the safety with expenses that are covered. In fact, it's the only asset out there that over time, you're actually being paid to be in it. It's not like it's drawing expenses. You know, in the stock market, you'll earn a return, but no money manager is paying you money to be in that asset outside of that return. Rates of return, great tax efficiency, plus you get the leverageability on it. So it becomes a real good foundation. So that's really kind of what I wanted to share today. And let's just open it up. And Kim, I don't know if we can open up for questions, and maybe I can check the chat box here and see if we have anything. Okay, I don't see any questions in the chat box. So let's open it up, and does anyone have any questions or want clarification on any of those concepts at all?
I think I would ask to begin with, Kelly, if somebody wants to maybe have a one-on-one with you. I don't know if you have a Calendly link or something you want to put up there, because I can tell you right now, I definitely want to get back with you. I know you and I have spoken before more on the investment side. But yes, this definitely intrigues me, and I'd love to set an appointment. But for anybody else out there, and if we put it up there, and obviously some other people watch this later that weren't on here today, maybe it'll have your link there.
Let me go grab it, and I'll put it in the chat box.
But any feedback from you guys out there, questions at all? This is definitely very intriguing. I'm sure a lot of us on here have probably got money set aside somewhere, even if it's just in your bank. And I don't know if the question, Kelly, might be from some people could be, can you start with any amount? You know, you got to get started somewhere, but kind of talk to that for a minute for someone, because I know back where I was just years ago, I didn't have a lot to set aside, but I could always have set aside a few $100s a month if you really wanted to, right? You got to prioritize where you put your money. Does it matter if someone comes to you and they can only start with a small amount?
Yeah, it comes down into the design of when you look at Index Universal Life as a foundational asset, there's a design component to it, there's a funding component to it, how do you invest in it, and then there's a use component to it. And so all three of those are important components. So you've got to get that structured appropriately. So Sean, that independent one-on-one evaluation, we can kind of look at where and how does it fit? Does it make sense for some people? I'll flat out tell them it just frankly doesn't make sense for you at this point in time. Could be based on your age, could be based on the liquidity that you have, could be based on the income streams. We'll look at that, but there might be a time that you can build to it and it starts to make some sense at some point.
Okay. If someone has money sitting in the stock market, mutual funds, can they take that money and roll it over and not be taxed, and roll it over and put it into one of these index funds that we're talking about?
The premiums for Index Universal Life have to come from non-qualified money, meaning not an IRA, not a Roth, not a traditional. So you would wind up having to liquidate, and that's some people choose to do that, take the hit, pay the tax, pay the penalty. But boy, that becomes a more difficult decision to roll that kind of money in there. Now, there might be other, that indexed annuity is like a cousin to the Index Universal Life. So it gives you a lot of the power of zero advantages, a lot of the safety advantages, great returns, actually even exceeding what the stock market is doing right now. Right now, meaning over the last 20 years. But it doesn't have the same liquidity that the Index Universal Life has. So you've got to kind of look at all the buckets of money and to determine where the best fit might be for the different pockets that we all have. Okay. Because a lot of us have been investing in traditional or Roth IRAs, and this might not at all be a good candidate for that money.
Okay. I could continue with questions. I don't want to take over anything from anybody out there, because this can almost turn into a one-on-one with you, Kelly, but open up to anybody, any kind of questions at all from Ms. Kelly. She's obviously extremely well-versed in this part of the industry of investing. Questions at all?
So as far as willability, or it is a life insurance product of some sort, I imagine. So are you buying a certain policy amount?
You are. You're basically buying a death benefit, and that's where that life insurance policy gives you kind of an added bonus. Whereas most other things you invest in, whatever the value is when you pass goes to your heirs. Like if you had a stock account, whatever it's worth goes to your heirs. With life insurance, you're kind of buying that extra death benefit bonus. Now, Aaron, the way we design it, most of our clients are not just looking for risk mitigation. I die, I want to take care of my wife and kids. They're looking for that savings component. So
Right.
traditionally, the way we design it is with the lowest death benefit possible to push in the maximum amount of funding so that we've got this bucket of growth that's giving us kind of that future. And what's interesting, I actually bought one of these for my granddaughter a couple of years ago. And I put money into it every month with the intent that when she's 21, she'll take it over and she'll just keep paying the premiums. When I illustrate that out, she'll be sitting when she's 65, if she keeps doing this, she'll be sitting on millions by the time she retires for the price of $100 a month. I mean, it's amazing when you have time on your side, what that can create and do as a long-term asset for somebody.
And you're still saying that money. So if I set this up for my kids, at any point in time, they're in dire straits and they need to pull some out, they can. And
Right.
then they would pay, I'm assuming, have to pay some kind of penalty or taxes if they pull out or not?
Well, pull out and in which way? So my intention for Faith is that she may get to the point that she wants to go to college and she needs a little extra help for it. So whatever it's done between now and the time she gets to that age, she could then use that leverageability. And she could pull some of it out to pay potentially for college. And then at some point in time, she could choose to put it back, or she would just pay the interest charge on it. And so there come to be some very interesting options with it as time goes forward. You can pull it out. If you pull it out, then it kind of loses that Roth-like capability. But if you loan it to yourself, then it kind of opens all doors and it keeps that value in there. Like I loan it to myself to buy my real estate. I just pay the interest charge.
And the interest charge varies according to whatever the interest rate is at that time?
According to the company, some of them cap at 5%, which of course, those guys are real attractive right now because with interest rates on the rise, that risk component of interest rising becomes a concern. But practically, the interest rate is not as big a concern because they're sitting on 30-year long-term bonds.
Yeah.
So that's what the interest rate is really based on in these companies.
So back to that same scenario, if all of a sudden you pulled money out, say they need, like you said, need it for college, pulled out 50,000 or 100,000, whatever, and you're paying the interest, do you have a certain amount of time to pay that interest back where you wouldn't have charged it yourself?
So every year on a policy, there are two components of cost. One is the cost of insurance. You're buying that death benefit, Aaron. But the other is if you have taken out a loan, it's the interest on that loan. And so it's calculated. You kind of know what that interest is going to be, and you know the amount you have outstanding in your loan. And so that's going to be your interest rate every year. Now, potentially, it's earning more than both of those costs. Okay. But in 2022, that is not the case. Market dropped, so it wasn't going to earn as much. So then you may have to come out of pocket with the cost of insurance or the interest rate. So it's back to designed right, funded right, used right. You want to make sure you're balancing all three of those components.
Okay, but generic question, but you're taxed on the money that you originally received, but as you invested, so there's no tax. And when you pulled out, you're just paying interest. There's no tax, there's no penalty on it, just the interest.
No penalty.
That's huge. Okay.
Yeah. So now you've got this growth mechanism over time. So I look at my little granddaughter, Faith. So she'll have this growth mechanism over time that by the time she's 60, 65, 70, and she has millions in there, and she starts to pull it back out, she would loan it to herself. The earnings on it would far exceed any interest that she'd have to pay, and she'd be set for life.
Very good.
The zero base you talk about, is that that account can't go below 0% earning? Like you can't take a negative? Is it a set
It's
bottom?
that power of zero. These are index products. What that means technically is rather than being in the market, so they aren't taking those dollars and investing them in the market. They're taking those dollars and buying options against the market. If it does what it should or what they expect, then great, they get a great return. If it doesn't, then they don't exercise the option, they let it go. They lose the buck instead of the $100 stock kind of thing. So that's how they guarantee that power of zero, where that account will not drop.
Gotcha.
Very good. Other questions? I see we had a few other people pop on here. You guys have questions at all for Kelly? And or feel free to click on that link. She put her Connolly link over there if you want to have a one-on-one with her and you feel more comfortable talking about obviously your certain situation, definitely set up an appointment with her. And more questions here. Obviously, we can wrap this up if nobody has questions, but I want to make sure we got plenty of time now. Got about another 12, 13 minutes. Any other questions for Miss Kelly? All right. Well, Kelly, I want to say excellent. I really, really enjoyed it. I will definitely be setting an appointment with you. Sincerely appreciate you doing this for all of us. And obviously, I look up to what you're doing. If you've been doing this for 20, 25 years, I'd imagine you're doing very well by now. So congrats for you. It's making me think I got to get proactive with my kids and have them. We've talked about it, but haven't pushed them enough to go, man, even if it's 50 to 100 bucks a month, what it could look like over time. So yeah, thank you so much for doing this. Thank you all for showing up here today. Again, every Tuesday, we'll do this at 10 a.m. This recording for those that are a part of this, our company will be on our Freedom team on Workplace, but also you'll have the recording if by chance you want to share it with any other agents you'd like to help them as well. So thank you, Kelly. I hope all of you guys have a wonderful day and a blessed week. Thank you so much, guys.
Thank you all. Take
Bye-bye.
care.